Ladies and gentlemen, if you care about preserving value, protecting your wealth, and staying ahead of what's coming, what I'm about to share with you could be among the most important few minutes you spend this year. We stand today at a crossroads, a moment not defined by whispers or rumors, but by shivering tremors in the foundations of the global monetary system. And those tremors, they're shaking gold and silver. When we look at the economy and the financial system, it's crucial to understand that nothing moves in a straight line. There are patterns, and these patterns repeat themselves in ways that are sometimes obvious in hindsight, but often invisible in real time. The economy, markets, and societies move in cycles, long cycles, medium cycles, and short cycles. The long cycles are especially important because they define the context in which everything else unfolds. They influence debt accumulation, credit creation, inflation, and asset prices. If you don't understand these cycles, you will be reacting rather than anticipating, and reacting is almost always costly. History shows us that economies accumulate debt over long periods. People and institutions take on credit to finance consumption and investment, and this credit expansion drives growth. It feels good in the short term. The economy grows, asset prices rise, and optimism becomes pervasive. But the reality is that debt is a claim on the future. If the accumulation is excessive relative to productive capacity and income generation, it becomes unsustainable. That point is not always clear until you reach a tipping point when the costs of servicing debt overwhelm the ability to pay it back. This is where the long cycle begins to shift. Every long cycle eventually enters a period of reckoning. The signs appear slowly. At first, credit growth slows, defaults begin to rise, and central banks begin to intervene in ways that are noticeable only to those who are looking carefully. If you are not paying attention, these early signals can be missed entirely. Investors often get caught in the optimism of the early stages, thinking that growth will continue indefinitely, failing to appreciate that the underlying dynamics are shifting. The consequences of ignoring these signals can be profound, particularly when leverage is involved. In such periods, precious metals, gold and silver, often start to behave differently from conventional assets. They are not always the first choice of the masses, and that is precisely why they become important. When currencies begin to lose purchasing power due to overextension of debt or aggressive monetary policy, people begin to look for stores of value that cannot be created at will. Metals have been used for thousands of years as a hedge against uncertainty, and their role becomes more pronounced when long-term cycles turn. Those who recognize this early can position themselves advantageously, while those who do not may experience significant erosion in real wealth. Understanding macro cycles is not just about observing debt and credit, it's about understanding human behavior within these cycles. People tend to overreact to good times and underestimate risks. They extrapolate the present indefinitely into the future. When times are good, confidence is high and people borrow more. When times are bad, fear becomes pervasive and they pull back. These behavioral patterns create the waves we see in asset prices and economic growth. The cycles are predictable in their structure, even if the timing is not precise. Recognizing the phases allows a person to align themselves with reality rather than fight against it. It is also important to see that these cycles are interconnected globally. Debt crises, currency devaluations, and shifts in interest rates in one part of the world often have ripple effects elsewhere. Markets are increasingly integrated, and the global financial system is highly interconnected. The same long cycle principles apply universally, though the timing and intensity may vary. This interconnectedness amplifies the consequences of misreading the cycle. A small error in understanding one economy can cascade into much larger losses when markets are linked. Those who approach investing without this macro perspective are often guided by short-term noise, headlines, quarterly earnings, and market sentiment. This approach can work in periods of stability, but it fails when long cycles turn. A full understanding requires patience, discipline, and a willingness to study patterns over decades rather than months. One must be willing to look at the numbers objectively and to confront uncomfortable truths about debt, inflation, and human behavior. Only then can you make informed decisions that are more likely to succeed in the context of these macro forces. Finally, there is an element of inevitability to long cycles. They are not random. They are the result of human nature interacting with credit, debt, and economic incentives. Patterns repeat because human nature is consistent, even if technology, policy, and instruments change. Those who understand this can anticipate inflection points and prepare accordingly. The goal is not to predict exact prices or dates, but to understand the broader arc and position oneself wisely within it. Awareness of the long cycle allows for decisions that are grounded in reality, reducing risk and enhancing the potential for opportunity when the cycle shifts. In conclusion, ignoring macro cycle awareness is one of the riskiest mistakes investors and decision makers can make. By understanding the patterns of debt accumulation and deleveraging, by recognizing the signals that precede turning points, and by appreciating the role of human behavior, one can navigate the complexities of the financial system with a greater degree of confidence. This awareness transforms uncertainty from a threat into an opportunity. It is the lens through which one can see the long-term trajectory of markets, prepare for volatility, and act with prudence rather than panic. In an environment of unprecedented debt and uncertainty, macro cycle awareness is not just valuable, it is essential. When examining markets, it is essential to understand that prices are ultimately determined by the interplay of supply and demand. This is a principle so fundamental that it is easy to overlook its implications until they manifest in dramatic ways. When supply and demand move out of balance, the consequences are amplified and the effects ripple through economies, asset classes, and investor behavior. A supply shock or demand shock is not merely a short-term event. It is a structural shift that can redefine value, sentiment, and opportunity for extended periods. A supply shock occurs when the ability to produce or deliver a commodity, asset, or good is suddenly constrained. This can happen for a multitude of reasons: geopolitical tensions, natural disasters, regulatory constraints, labor disputes, or technological limitations. When supply is limited and cannot respond immediately to growing demand, prices rise. This is not speculation. It is a direct result of scarcity interacting with human needs and expectations. Investors often underestimate the magnitude of these shocks because they focus on historical supply levels rather than structural changes that can create persistent shortages. Conversely, a demand shock occurs when the desire or need for a product suddenly increases or decreases in ways that are not easily predicted. This can result from shifts in consumer preferences, changes in wealth distribution, policy changes, or systemic uncertainty that drives people toward or away from certain assets. Demand shocks are particularly interesting because they reveal human psychology at scale. When individuals or institutions suddenly seek safety, liquidity, or hedges, their collective behavior can transform markets in a very short time. Precious metals, for example, are often the recipients of this type of shock as people gravitate toward assets that retain intrinsic value. When confidence in conventional stores of wealth diminishes, the interaction of supply and demand shocks is where the dynamics become particularly potent. When supply is constrained and demand simultaneously surges, the impact on prices can be exponential. History is full of examples in which markets were unprepared for the convergence of these forces. Those who understand the mechanics and the potential triggers are better positioned to anticipate shifts rather than merely react to them. This is not about timing the top or bottom perfectly, but about recognizing that structural imbalances exist and will manifest in measurable ways. Understanding these shocks also requires appreciating the feedback loops they create. Rising prices can suppress demand in some areas while stimulating speculative demand in others. Limited supply can incentivize alternative production methods, but these often take time to materialize. In financial markets, the perception of scarcity or abundance can be as impactful as actual scarcity or abundance because markets are forward-looking and prices reflect expectations as much as reality. Anticipating these feedback loops requires a disciplined approach to data, history, and behavioral patterns. Another critical aspect is that supply and demand shocks do not occur in isolation. They interact with broader economic, political, and social conditions. A supply disruption in one region can cascade globally, particularly in a world where markets are interconnected. Similarly, a surge in demand in one sector can put pressure on adjacent sectors, creating ripple effects that are not immediately apparent. To navigate these dynamics, one must think in systems rather than silos. Observing isolated variables without considering their systemic implications is a recipe for surprise and miscalculation. Investor psychology plays a central role in amplifying these shocks. When markets sense scarcity, fear can accelerate price movements. Conversely, when abundance is perceived, complacency can set in, masking underlying risks until a sudden reversal occurs. Those who understand these behavioral tendencies can anticipate opportunities created by others' overreactions or underreactions. It is not a matter of predicting human behavior perfectly, but of recognizing consistent patterns and positioning oneself to respond rationally when the market overcorrects or underestimates. It is also important to note that supply and demand shocks often precede broader systemic changes. They are early indicators of structural stress within economies or markets. By the time conventional signals, such as official statistics or central bank reports, reflect these pressures, much of the market adjustment may have already occurred. This is why attention to real-time indicators, market signals, and subtle shifts in production or consumption is crucial. Understanding the signals allows one to act before the majority recognizes the change, which is where real advantage lies. In commodities like silver and gold, these dynamics are especially pronounced. Mining output is constrained by geological, technical, and regulatory factors. At the same time, demand is influenced not just by industrial use, but by the psychology of safety, wealth preservation, and risk mitigation. When a supply constraint coincides with rising global uncertainty, the result is an accelerated price adjustment. Investors who ignore these fundamentals may find themselves reacting to market movements rather than benefiting from them. Ultimately, supply and demand shocks are not anomalies. They are natural expressions of how markets operate. They reveal the fragility and interconnectedness of systems, the predictability of human behavior in certain conditions, and the importance of positioning oneself with foresight rather than reaction. Recognizing these forces and understanding their potential consequences allows investors, businesses, and policymakers to navigate complexity with clarity, prudence, and resilience. Those who prepare for these shocks rather than ignore or fear them are best equipped to preserve value and capitalize on opportunities when the inevitable imbalances occur. In financial markets and economic systems, risk is inevitable. It cannot be avoided. It can only be understood, measured, and managed. Risk exists because the future is uncertain, because human behavior is unpredictable, and because the world is constantly changing. Some risks are obvious and widely recognized, while others are subtle, hidden beneath the surface until they manifest dramatically. Understanding the nature of risk is not about eliminating it. That is impossible, but about positioning oneself so that the outcomes, both expected and unexpected, are survivable and ideally advantageous. Uncertainty is the core of risk. The term risk is often misused, with people equating it to volatility or temporary loss. In reality, risk is exposure to outcomes that are not fully predictable and that may be damaging if they occur. In an environment of rising debt, evolving policy interventions, and complex global interconnections, uncertainty is higher than at any point in history. This makes hedging essential, not optional. Those who underestimate uncertainty are often surprised when the system shifts in ways they did not anticipate. Conversely, those who accept uncertainty as a constant are better able to structure their portfolios, their businesses, and their lives in a way that provides resilience and optionality. One of the most persistent and pervasive risks in modern economies is inflation. Inflation erodes the purchasing power of currency, diminishes real returns, and can create distortions in investment and consumption behavior. It is not always visible when it begins because it can accumulate gradually, hidden in the prices of goods and services, asset markets, and debt obligations. By the time it becomes evident in official statistics or public consciousness, much of the damage may already be done. Hedging against inflation, therefore, is not merely a defensive tactic. It is a proactive strategy that seeks to preserve value in an environment where conventional measures of wealth may be losing efficacy. Precious metals, such as gold and silver, have long been recognized as effective hedges against inflation and uncertainty. They are tangible, scarce, and universally recognized as stores of value. Unlike paper currencies, which can be created at will by central authorities, metals cannot be produced quickly to meet demand. Their role becomes particularly pronounced during periods when confidence in fiat money is eroding or when systemic risk is increasing. The value of these assets is not static. It is shaped by human perception, by the collective understanding that scarcity and intrinsic worth provide protection against financial instability. Risk is amplified when leverage is involved. Borrowed money magnifies both gains and losses, but it also makes participants more vulnerable to shocks and volatility. In environments of rising uncertainty, leverage can turn a small disruption into a catastrophic failure. This is why understanding the interplay between risk and leverage is critical. Hedging is not just about holding assets. It is about structuring exposure in a way that mitigates downside while maintaining upside optionality. It requires a deep understanding of how different risks correlate, how markets interact, and how human behavior responds under stress. Another dimension of risk is geopolitical and policy uncertainty. Governments, central banks, and regulatory bodies have the ability to influence markets, interest rates, and currency values in ways that are often unpredictable. Policies may be reactive, sometimes contradictory, and often aimed at stabilizing short-term conditions at the expense of long-term consequences. Understanding these dynamics is crucial because they affect everything from asset prices to trade flows to inflation expectations. Investors and decision makers who ignore these factors are essentially navigating blindfolded, exposed to systemic shifts they did not anticipate. Behavioral responses to uncertainty further complicate the landscape. Humans tend to overreact to fear and underreact to opportunity. When uncertainty rises, panic can spread quickly, driving asset prices away from fundamentals and creating dislocations that may persist for long periods. Hedging is effective not because it prevents uncertainty, but because it provides stability and flexibility when the unexpected occurs. It allows rational decisions in moments when others are driven by emotion, allowing long-term goals to remain intact despite short-term turbulence. A comprehensive approach to risk and uncertainty requires diversification across multiple dimensions, asset classes, geographies, and strategies in a way that reduces correlated exposure. It is not about predicting exact outcomes, which is impossible, but about preparing for a range of plausible scenarios and ensuring that no single shock can create catastrophic consequences. By doing so, one can navigate volatility, preserve wealth, and maintain optionality when opportunities arise. Finally, understanding risk and hedging against inflation is not merely a technical exercise, it is a mindset. It requires humility in recognizing that the future is unknowable, discipline in implementing strategies that may seem conservative in the short term, and patience to wait for favorable conditions to materialize. Those who embrace this mindset understand that the world is inherently uncertain and that wealth preservation is as much about surviving the inevitable shocks as it is about capturing upside. They recognize that inflation, market disruptions, and systemic risk are not anomalies, but natural features of economic systems. Preparedness, not panic, is the key to navigating these challenges. In conclusion, risk, uncertainty, and inflation are intertwined forces that shape financial outcomes. They are unavoidable, but they are also navigable. Hedging is not about prediction, it is about preparation. By understanding the mechanics of uncertainty, by appreciating the historical role of assets like precious metals, by managing leverage and behavioral tendencies, and by diversifying across systems and scenarios, one can build resilience. In a world where change is constant and outcomes are never guaranteed, the ability to anticipate, prepare, and act wisely under uncertainty is the most powerful advantage any investor or decision maker can have. One of the most underestimated elements in investing is the psychology of the participants. Markets are not just driven by fundamentals, they are driven by human behavior, by fear, greed, complacency, and overconfidence. Understanding investor psychology is essential because it shapes how markets move, how cycles unfold, and how opportunities and risks present themselves. Markets are not purely rational. They are a reflection of collective perception and emotion. Those who understand this have a significant advantage over those who react blindly to price movements. At the heart of investor psychology is the tendency to follow the herd. People extrapolate recent trends into the future, assuming that good times will continue indefinitely and that bad times will be short-lived anomalies. This extrapolation leads to periods of excessive optimism where assets are overvalued and periods of excessive pessimism where fear dominates and assets are undervalued. Both extremes create opportunity for those who recognize them, but only if they are willing to stand apart from the crowd and act in opposition to prevailing sentiment. Timing is intimately linked with psychology. Turning points in markets often occur not when fundamentals reach extremes, but when perception shifts. The shift may begin subtly with a growing sense of unease or confidence, and then accelerate as more participants follow the emerging sentiment. The early stages of a turn are rarely obvious. They require a keen eye for patterns, an understanding of cycles, and the discipline to prepare in advance. Recognizing when the mood is about to change allows an investor to position themselves ahead of the market rather than chasing prices after the turn has occurred. Human emotions amplify market movements. Fear causes selling to cascade, driving prices below intrinsic value. Greed pushes buying to unsustainable levels, inflating bubbles. Complacency hides risks until they materialize unexpectedly. By observing these emotional patterns, one can anticipate turning points before they are fully acknowledged by the majority. Markets are forward-looking, and shifts in sentiment are often the first indicators that a cycle is turning. Those who ignore psychology often find themselves trapped by their own biases, late to react, and overexposed to risks that are now unavoidable. Investor psychology is also cyclical. Confidence grows in the early stages of economic expansion, often leading to over-leverage and excessive risk-taking. During the late stages, overconfidence peaks and corrections begin. In the contraction phase, fear dominates and many retreat entirely from markets. By studying these psychological cycles, one can recognize when participants are likely to overreact in either direction. This recognition is essential for identifying inflection points where risk-adjusted opportunity is greatest. Another key aspect is understanding the difference between price and value. Psychology often causes markets to deviate from fundamental value for extended periods. Prices may rise due to collective optimism or fall due to collective fear, irrespective of underlying conditions. By focusing on value rather than reacting to short-term price movements, investors can position themselves for long-term gains while avoiding the pitfalls of emotional decision-making. Timing the turn does not mean predicting exact highs or lows. It means recognizing when sentiment is about to shift and when the balance between fear and greed is likely to tilt. Preparation is critical. Anticipating a turn requires having a plan and executing it with discipline. Many investors recognize a psychological shift only after it has manifested in the market, at which point the opportunity is diminished and risk is heightened. Those who study historical patterns, monitor early signals of changing sentiment, and maintain flexibility in their portfolios are far more likely to take advantage of turning points. Timing is less about prediction and more about observation and readiness. Psychology also interacts with liquidity and leverage. Highly leveraged markets are more sensitive to changes in sentiment. A small shift in psychology can trigger outsized movements as participants rush to adjust positions. Similarly, markets with low liquidity can amplify emotional responses, creating volatility that seems disconnected from fundamentals. Understanding these dynamics is crucial for anticipating turning points and managing risk. Finally, investor psychology is intertwined with global events, policy decisions, and structural market conditions. Uncertainty increases emotional reactions, while clarity reduces overreaction. Those who can separate noise from meaningful signals, who can distinguish transient emotion from structural shifts, are better positioned to navigate market turns. Markets are complex systems, and psychology is the lens through which participants interpret reality. Misreading it can be costly. Understanding it can be highly profitable. In conclusion, markets are as much a reflection of human behavior as they are of economics and finance. Investor psychology shapes cycles, drives extremes, and signals turning points. Timing the turn requires observing these emotional patterns, understanding historical behavior, and preparing in advance rather than reacting in the moment. It requires discipline, patience, and the courage to act when sentiment is at its most extreme. Those who master this aspect of investing gain a significant edge, positioning themselves to navigate uncertainty, capitalize on opportunities, and avoid the pitfalls created by the irrationality of the crowd. In a world defined by cycles, leverage, and uncertainty, the understanding of psychology is not optional. It is essential. We are not at the end of a chapter. We are at the beginning of a new one. defined by shifting currencies, rising debt burdens, uncertain geopolitics, and fragile faith in conventional finance. If you wait until everyone else realizes what's happening, you'll be too late. Now, while prices are still writing their story, while supply is tightening, while demand is growing, this is your window. Prepare, position, protect, because the alarm has sounded. The alert is real. Thank you for listening. May you act wisely, think long-term, and preserve what matters most.